Let's understand the cash flow from operations. Cash flow from operations is calculated by taking the profit before tax value from the profit and loss account and then adjusting it for all non-cash and non-operating items, and then accounting for any changes in working capital, and finally deducting the taxes paid. This will be more clear when we look at an example. But before we do that, we will look at the profit and loss account statement, and from there we will move on to the cash flow from operations. The company generates revenue through sales and services. The company also incurs operating expenses which needs to be deducted from this revenue. Thus, the company generates the operating profit. Other than the operating profit, the company may also earn other income through different sources like investments or bank fixed deposits or even mutual fund investments. The company charges depreciation on its fixed assets to the P&L account every year, which is a non-cash expense. If the company has any borrowings, then it needs to pay interest on that borrowing. Finally, the company pays taxes and we get the profit after tax value or the net profit. Now let us understand how the cash flow from operations is calculated using the profit before tax value of 1,850 crores as our reference. The profit before tax was 1,850 crores. The company has to do adjustments for the net cash flow, that is, account for any non-cash as well as non-operating items. A few of the examples are depreciation. If the company has deducted depreciation from the profit and loss account, then that depreciation is basically a non-cash expenses, meaning no cash has gone out of the business for this particular expense. So we add it back to the profit before tax value of 1850. Next, we add any interest expense which was deducted from the P&L account. Since interest expense is not an operating expense, it has to be added back to the profit before tax value to calculate the cash flow from operations. We need to deduct any dividend income that the company has received. Dividend income is not an operating income. This was an income which was added in the profit and loss account and therefore needs to be deducted back from the cash flow statement. If the company has any profits on sales of property, then that also needs to be deducted. Again, this is a non-operating profit or an income. So all non-cash expenses and incomes as well as non-operating expenses and incomes needs to be adjusted. Similarly, if the company has received any interest from loan and deposits that it has, then that also needs to be reduced because interest is a non-operating income. If the company has written back any provisions which it had done in the earlier years, then that also needs to be removed out while calculating cash flow from operations. When a company writes back its provisions, then that increases the profit. But since this is a non-operating item, it needs to be removed out. If there are any write-offs or bad debts from the profit and loss account, that's an expense. And since this expense is a non-operating expense, it needs to be added back to the cash flow from operations. If the company has gained any foreign exchange or has lost in the foreign exchange, then that needs all to be adjusted. In this particular example, the company has gained from foreign exchange which was added to the P&L account. Now, while calculating the cash flow statement or while calculating the cash flow from operations, we need to remove it out. So, these are a few examples of adjustments of non-cash as well as non-operating items. The total of all these is 353 crores. So along with the profit before tax of 1850 crores, the company has earned an additional 353 crores. So let's move on to the next page. Now we need to adjust for working capital changes. So any items which are operating in nature and through which any cash inflows or outflows have happened, then those will need to be adjusted. So let's look at few of the examples. The first one is either increase or decrease in inventories. If the company has purchased inventory, if some cash has gone out, then that needs to be adjusted. That is, it needs to be reduced. And if the company has sold some inventory and has received cash, then that also needs to be added back. So in this particular case, the company's inventory has decreased. Therefore, it has received cash of 26 crores. In the next example, the company has received money from the debtors or trade receivables. That is, from those customers from whom the company had to collect payment for its credit sales. So in this case, the company has received 32 crores from its customers in cash. These are all cash adjustments. In the third case, the company's current assets have increased. Therefore, cash has gone out of the business. If the cash has gone out of the business, it needs to be deducted from the cash flow from operations. In this case, the company's loans have decreased and it has received money back. In this example, the company has managed to increase its trade payables, meaning in the profit and loss account, the company had shown expenses for purchases it had done through its suppliers, but 42 crores of trade payables have not been paid yet, and therefore it gets added back here. In the next example, company's financial liabilities have increased and it has paid for those financial liabilities. So there is an outflow of cash of 14 crores. In the next example, the current liabilities have decreased, meaning the company has paid for those current liabilities. 31 crores have been paid in other current liabilities. Finally, the total of this is 61 crores. There may be more items in the working capital changes, but these are a few examples to understand how the cash flow from operations is calculated from the profit before tax. So finally, we see that some cash has been generated through operations. The total is around 2,264 crores. Out of this, finally, we adjust for any taxes paid, which is 621 crores. And we have our cash flow from operations. So from profit and loss account, we do a reverse entry to do adjustments for the non-cash and non-operating items, as well as for any changes in the working capital. And this way we calculate the cash flow from operations. Difference between the profit before tax and the cash flow from operations is that cash flow from operations accounts for only cash, expenses and incomes, whereas profit before tax accounts for all expenses, whether done in this year in cash or not, as well as all cash incomes as well as non-cash incomes are adjusted in the profit before tax. So we want the cash flow from operations to be at least equal to the profit before tax or even more than the profit before tax value. Thank you for watching this video.